All right, so let's talk about Warren Buffett, but not the Buffett of today. We're going way back. Before Berkshire Hathaway was a household name, a young Warren Buffett ran this small, private investment partnership. And through his yearly letters to his partners, he basically laid out the entire philosophy that would make him a legend. We're going to dig into the key lessons from those very letters. So let's just start with this quote, because it kind of turns everything you'd expect from an investing genius on its head. Right out of the gate, Buffett told his partners, "Look, I can't predict the market. I'm not a fortune teller." It's an incredible statement. So, if his secret wasn't predicting the future, what on earth was it? Well, the secret sauce, it turns out, wasn't some complex stock-picking formula. It was the very foundation of the business itself. He wasn't just building another investment fund. He was building a real, genuine partnership. And it all started with a set of crystal-clear, non-negotiable rules that made sure everyone, and I mean everyone, was on the same page from day one. And maybe the most important rule of all was this: he was in the exact same boat as his investors. This wasn't some typical client-manager deal. His money, his family's money, pretty much his entire net worth was invested right alongside theirs. It was the ultimate put your money where your mouth is, and it guaranteed that his only goal was making them successful. You can really see this in his fee structure, which was honestly radical for the time. He only got paid well if his partners got paid first. Think about it. He took a cut of the profits, but only on the gains above a 6% annual return. If the partnership didn't clear that 6% hurdle, he made nothing, zero. Now compare that to a typical fund that just charges a flat fee on your assets, whether they make you money or lose it. This structure wasn't just fair, it was a screaming signal of confidence. Okay, so the partnership's foundation is solid, but how did he actually invest the money? You might be picturing some super complex high-tech model, right? Nope, he did the exact opposite. He simplified his whole approach by sorting every potential investment into just 3 simple buckets. The first and biggest bucket he called the generals, and these were just what they sound like, your classic value investments. Good, solid companies that the market, for one reason or another, had basically thrown in the bargain bin. The whole key was buying them at a massive discount to what he figured their actual business value was. That gap, that cushion between the low price he paid and the high value he got, was his famous margin of safety. Bucket number 2 held what he called workouts. You can think of these as special situations. What was so cool about them is that their success had almost nothing to do with the day-to-day craziness of the stock market. Instead, the profit was tied to a specific, predictable corporate event, like a merger that had already been announced. It was kind of like knowing the final score of a game before it was over. This gave the portfolio a nice, steady source of returns no matter what the market was doing. And then we have the third bucket, the rarest and maybe the most interesting, the controls. This is where Buffett went from being a passive investor, just buying a piece of a company, to being an active owner. He wasn't just buying stocks anymore. He was buying enough of the company to actually take control and start calling the shots himself to unlock all that hidden value he saw. And to really see what a control situation looks like in practice, we have to talk about the incredible turnaround at Dempster Mill Manufacturing. This was a struggling farm equipment maker in Nebraska that Buffett's partnership started buying up back in 1956. So after he finally gained control, Buffett brought in this tough-as-nails manager named Harry Bottle. And Bottle's job was simple: turn all the lazy, unproductive assets into cash. And just look at these numbers. It's wild. In under 2 years, he slashed all this extra inventory, paid off every single dollar of debt, and grew the company's cash from basically nothing to almost $2.5 million. It was a total night and day financial transformation. And here is the bottom line, the big payoff. The partnership had been buying its shares for less than $20. But by actually going in and improving the business, not by guessing which way the market would go, the final value they got for each share was about $80. This was an absolute home run, and it proved that incredible value could be created by thinking like a business owner, not a stock trader. Okay, so this all brings us beyond just the mechanics and the strategy and into the psychology. I mean, what was really going on inside Buffett's head? His letters give us this amazing window into a mindset that was built on patience, discipline, and just an unbelievably clear focus on what truly matters. I mean, listen to this. This mindset is completely the opposite of how most people think. For Buffett, a stock price that was going nowhere wasn't a problem. It was an amazing opportunity. He saw time as his greatest ally. That's what let him spend years just patiently buying up shares of a company like Dempster while nobody else wanted it. While everyone else was chasing quick profits, he understood the incredible power of just sitting still. And this one. This might be his most famous saying ever. And it was really the guiding light for the whole partnership. See, the market is emotional, right? It swings wildly between fear and greed, and that creates these crazy ups and downs in price. Buffett's genius was his ability to just completely tune out all that noise and focus on one thing and one thing only: the real, underlying intrinsic value of the business. So after 13 years of just spectacular results, compounding money at a rate that made the market look silly, Warren Buffett did something that nobody, and I mean nobody, saw coming. He decided to close the partnership. It's the ultimate question, right? You're at the absolute top of your game, the king of the investing world, and you decide to just walk away, return all the money, and call it a day? Why would you do that? Well, his reasons, which he laid out in his final letters, are just a masterclass in self-awareness. First, he looked at the market and saw a speculative casino, a game he just wasn't willing to play. Second, his own success had become a problem. The partnership was now so big that it was hard to find those small, nimble opportunities that worked so well before. And finally, and maybe most importantly, his own personal goals had changed. He felt like he'd already won the game, and he didn't want to spend the rest of his life on that endless treadmill. When you really go back and read these early letters, you realize the lessons here are so much bigger than just buying cheap stocks. It's a blueprint for how to think rationally, how to act with integrity, how to align your interests with others, and how to know when it's time to walk away. These aren't just investing principles. They're principles for business and, frankly, for life. So I think the biggest takeaway from all of this is learning to apply this core concept more broadly. Buffett always demanded a buffer, that margin of safety, between the price he paid and the value he got. So the question I want to leave you with is this. In your own career, in your finances, or in your big life decisions, where have you built in your own margin of safety?